Oh, feeling a little sick, ladies and gentlemen. I might have to go to a pharmacy to get a prescription. And I'm definitely not going to Walgreens simply because Jeremy LaFave likes it. Instead, I may consider going to CVS if the price is right. Welcome back to Strongman Personal Finance. I'm Christopher Bale, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3. You can buy that, or you can go pay Jeremy LaFoo $20,000 to learn how to read a 10K. It's up to you. Now, today, we're going to look at CVS stock. And I actually had a bunch of stuff pulled up on Morningstar, and then a bunch of idiots at the local library took all the subscription fills, and now I can't get on the website and show you the percentages. So I'm pissed. But when we get to the stock analyzer, I'm going to show you, or try to at least explain why I put some of the numbers I did, just based on what I saw on Morningstar. One of the big flaws of Everything Money software, and it's great software, and that's why I'm actually paying for it, because I like it. One of the big flaws is that they need to have like vertical and horizontal analysis, which I don't know why that's a big deal why that's a big deal for them to implement, because Morningstar has all the percentages. So Morningstar will show you revenue change year over year, revenue as a percentage or net income as a percentage of sales for each year. That data would be really, really helpful when doing analysis, because sometimes stocks have like freak aberration years. And if that happened recently, that could really throw off your analysis and really screw up your projections. So it's always good to look at longer term averages, or maybe look at year to year and discount any random years when you're trying to determine your assumptions. So CVS, PE of 16, profit margin 2.6, not very good. And that's actually been going down, at least from what I saw in Morningstar. It's been going slowly down. Gross margin, 17%. That's roughly in line with their historical performance. It was a little bit higher, 4, 5, 6 years ago, but it's dropping slowly, but not as fast as Walgreens' gross margin is dropping. Walgreens is dropping like 1% a year. Dividend yield, 2.3. I hate dividends, so I'd only have this in a tax advantage account. And then you have return on invested capital, 5-year return on invested capital, not that great, 5.8%. It's a low margin business, not very profitable. Now, looking at the income statement, so net income or revenue is increasing every year, which is a good thing, and it's actually been increasing by a decent chunk. One thing that worries me about some companies is because of the pandemic, they had that one fluke year where revenue freaking skyrocketed, and everybody's using their projections based on that new revenue, when the revenue could actually dip for a lot of these companies that benefited during the pandemic after all the stimmy runs out. But with CVS, you can see, starting at $116 billion, it's been going up steadily every single freaking year, which is awesome. That makes it a lot more easier to feel confident about projecting revenue growth going into the future. When you see like random fluctuations, up, down, up, down, up, down, down, up, it's risky. I don't like it. Same thing with gross profit. Gross profit has been increasing, even though I think margins have been slightly squeezed, probably by competition. Net income is a lot more all over the place, and that's one of the problems with this. I think the free cash flow is a lot easier to see or project for this company, because you see revenue was $3.68 billion in 2012, 4.2, 4.8, 4.7, 4.8, 5.3, 3.01, 4.33. It's all over the freaking place, okay? I don't like to see that because it just makes it harder to project, but whatever, you can use averages. Balance sheet, whatever. We can look at the 8 pillars. I think the current ratio is fine. Current ratio. Am I blind? Did they change that? Where's the current ratio? I guess they got rid of the current ratio. Whatever. Cash flow. So operating cash flow, $6.8 billion in 2012. 5, 6, 8, 9, 11, 7, 10, 15, 14. So, okay, it's been growing, but it's kind of been uneven. Free cash flow, $4 billion in 2012, and now we're up to $11 billion. So, free cash flow has also been fluctuating a little bit. With CVS, I would use averages. It's not
there are pretty decent fluctuations in free cash flow and operating cash flow, but they're not like these steady increases that you can kind of guess at. So it's always good in that sense to use an average over the last couple of years, or maybe even discount a fluke aberration year. So 8 pillars, we already looked at that. Let's go ahead and look at the stock analyzer. Okay, so I used some very conservative assumptions with this, and this was based on my Morningstar analysis. Let's see if Morningstar is actually available, okay? There's all these people at the library, like, if I log out for even a second, I get denied access. We're back. All right, so let's go look at some of these percentages, and I'll show you why I chose some of the percentages that I did. So if you have a Morningstar subscription, which you can get for free at the library, I think it's a great supplement to Everything Money. Because as you'll see, you know, the 8 pillars, I mean, okay, they have the 5-year average revenue growth, but sometimes I like to look year over year. For example, if you click on growth down here in the key ratios, you can see revenue year over year. So starting in 2011, it grew from 11%, and then it grew by 14%, 2, 9, 9, 15. And then here's the thing right here. So like, look at this freak aberration year. From 2018 to 2019, in 2019, revenue grew by 31%. That seems like a fluke when you look around it. 4%, 5%, 31%, 4%, 11%. That seems kind of crazy to me. So I was very conservative, and I said, okay, CVS can't grow forever. So on the low estimate, I'll use 3, and on the high estimate, I'll use 5. And that's being extremely conservative. Net margin. So if you go to profitability, you can see net margin. That's their bottom line profit. As you can see, it's been going down. So in 2011, it was 3.23%. And now we go all the way to the last 12 months. It's 2.59. So it's been slowly going down time over time. That's why you'll see the net margin that I use is extremely conservative on Everything Money as well. So I highly recommend you freaking use this. Okay, this would be really, really helpful to supplement Everything Money until they can actually get the stuff in there. So revenue growth, I said, between 3 to 5%. Share change, they've been issuing shares, but it's slowed down recently. So I'd said worst case, 1.5% every year going forward. Best case, they start buying shares back. Best case. Profit margin, I was very conservative here. So as you can see, if we go back, net margin has been dropping to about 2.59. So I went 2, 2.35, and 2.7, worst to best case. Price to earnings ratio, I was a little nice. Usually I use 8, 10, and 12. I don't know why they have a PE of, I guess that's like, let me see, 20.54. Yeah, that's the 5-year average PE. So I was still conservative, and I said 10, 12.5, and 15, which is the market average. That's probably the best case going forward. So that's that. 15% desired annual return, analyze, and it's in the green when it comes to discounted cash flow, and not too far from the high assumptions. So these high assumptions aren't crazy radical, but I don't think they're necessarily going to come to fruition. I mean, 5% revenue growth, share buybacks, 2.7 profit margin. It's possible, but not likely. Just looking at trends, okay? So, would I buy this stock? Right now, no. It's trading for $87. And if you look at the midpoints, it's got a buy point of $56 based on earnings, because earnings kind of suck for this company, and discounted cash flow of 90. So it's a buy for cash flow in the middle assumption, but it's not a buy right now for earnings. Now, because I want a margin of safety, I'm going to buy somewhere in the middle, maybe on the low end of that middle assumption. Or if I want to be super conservative, maybe I'll go on the low end of the low assumption or the high end of the low assumption. I would probably buy this stock around $70, in my humble opinion. Now, I know you people are like, oh my God, you're so crazy and you're so risk averse. Yes, I'm not going to buy an individual stock unless I am assured that I'm going to get a massive return. Because otherwise, I'm not going to take the risk of buying an individual stock. I'd rather just buy a total world index in my tax advantage account. So that's my thought. I would buy CVS at about $70, unless I saw a little bit more data to see where profit margin was going. If I saw they started to buy back shares, maybe you could juggle the assumptions a little bit. But right now, $70. Anyway, that's it. Hope you liked the video. I wouldn't buy, we can actually do Walgreens next. I'd rather buy this than Walgreens, but that's another story. Like, subscribe, Tell your friends about me. Y'all have a wonderful, delicious, superstitious, cockalicious day. Choose. Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now.